Again, this webinar is being recorded for quality assurance purposes. We revisit the webinar and from our side, identify ways to further improve on top of your respective feedback, which we will solicit at the end of the session. Okay, so we started the session with a quick revisit on Accounting 101 and setting the context for a financial cooperative engaged in the business of credit and deposit and savings generation. We discussed why ALM is a critical part of a successful financial cooperative. Its role in managing and helping to manage the financial risks encountered by the business, and the mechanisms for which ALM can influence the way lending and savings unit price their respective loans and deposit products. And we've emphasized the use of fund transfer pricing, which in other units could be referred to as transfer pricing rate or cost of money interest rate. But the bottom line purpose is to guide the commercial rates being pegged or are arranged with external customers towards a profitable arrangement insofar as the financial financial cooperative is concerned. Now, in our example on FTP or TPR rather, FTP, our example here is that the deposit that the savings unit brought in for the financial cooperative to service is for 1 year at 1 million pesos. And then it was decided that it will lend out. The cooperative will likewise lend out 990,000 to a borrower for 2 years. So in this example, we see a clear mismatch of maturity dates. And when you look at it from a time perspective, today, since the transaction in our example, the transaction happens within the same day. So technically, you can say that what the money that came in from the savings unit is passed on to the other side, to the lending unit. So technically, wash sila. So they are matched. So the deposit that came in to the cooperative will be disbursed on the other side. Approximately almost the entirety, 99%, would be disbursed as a loan. So your cash in is negated by the cash out a few hours after. So it's negated. That's technically square or matched or wash. The complication arises when you look at the cash flows in terms of their respective maturity. Recall that the loan is for 2 years. The interest rate is at 8.5% per annum. That means for the next 2 years, the financial cooperative will receive coupon payments on an annual basis. And then at the end of the second year, the term of the loan, it's supposed to likewise receive back the principal amount. Now, if you plot the cash flow of the deposit, the outflow now is on the interest expense for the 1-year time deposit plus the principal amount of the deposit. So in this particular situation, we can see that there is a misalignment of cash in and outflow. Because the maturity of the loan is for 2 years, but the maturity of the time deposit is for 1 year. So from the perspective of ALM, there is a net difference. You are net short for the next 1 year, and you are net long after 2 years. When I say net short and net long, meaning I'm net short, net liability for the next 1 year, and I'm net asset for the next 2 years. From a financial institution perspective, there is a gap because the maturity of the cash outflow will occur ahead of the cash inflow event. So in this case, the role of ALM is to decide what to do with that gap. Of course, from a legal perspective, the cooperative must find a funding source to plug that gap. The question is, where would the cooperative get it, and at what price, and what other commercial terms and conditions to attach? All those questions with the backdrop of making sure that the cooperative minimizes its costs and expenses attributable to raising incremental funds for the cooperative. Again, ALM is helping the cooperative to achieve the profit goals of generating maximum returns with as minimum amount of cost and risks as reasonably possible. When you look at the cash flow schedule, so in 1 year's time, we have an outflow, but the inflow, the matching inflow will only happen after 2 years. So we have a 1 year gap between the two events. Now, what do we do about it? There are multiple approaches to taking it. And as mentioned, the lending units and the savings units, once they close the deposit or the loan with their customer, they move on to the next one. For ALM, this question is asked every day. Even for transactions that have already been decided upon, the next day you will revisit, is the decision that we made yesterday still relevant today, or do we need to take a different course of action? Because the financial markets in general change rapidly depending on economic conditions. Interest rates could go up or down depending on reactions on the results of inflation or any demand side or supply side effect that translates to a change in the economic variables. Speaking of economic variables, let's focus on one of the primary concerns, interest rates. Suppose that at the moment, this is the level of interest rates. Now, at the time that you both accepted the 1 year time deposit at 3% and disbursed the 2-year loan at 8.5%, the forecasted outlook of interest rates is that interest rates by the time the deposit would have matured 1 year from now, the outlook is that the interest rates are going down. That's why treasury units and ALM would always have an opinion on the direction of the economy, of the direction of the relevant market variables. That's because their opinion would matter in terms of their decision on what to do with the current financial risk profile that the cooperative has. And if the outlook for the next year is that interest rates are going down before maturity of the deposit, then you can keep the transaction untouched, meaning we will not do anything. However, a few days or a few weeks before the maturity of the 1 year time deposit, you can then borrow for another 1 year via another deposit instrument or channel taking advantage of lower interest rates during that time, using the proceeds of that new loan or that new deposit to plug the gap that you currently have by then, and then match the maturity of the deposit with the maturity of the 2-year loan. That's one action. Again, if the forecast is that interest rates are going down, that means if I wait 1 year from now, before the maturity of the time deposit, I could borrow during that time at lower interest rates. Therefore, taking advantage of cheaper sources of funding, making the margin of the co-op a lot higher. The effect is that a day before mag-mature yung time deposit, I borrow for 1 year, 1 year time deposit again. Kung 3% to, probably, maybe 2% or 1.5% by that time. Use the proceeds to fill the gap and pay the maturing 1 year time deposit 1 year ago. And then wait for the loans to come back to be collected and then pay the new 1 year time deposit. That strategy is applicable if the forecast is that interest rates are going down. And ALM is confident that that forecast, that thesis, remains valid for the foreseeable future. Of course, since the initial action is don't do anything today, and if the outlook changes, you can switch and pivot, and immediately take action. However, sabi ko nga, ALM has to do this evaluation on a daily basis. They have to revisit it every day because their interest rates might change. Their outlook might deviate, or the actual rates might deviate from their outlook, and they have to take action accordingly. Now, what if the outlook is that interest rates are going up? In such a way that by the time the 1 year time deposit matures, it would already be a lot more expensive to refinance that portion of the time deposit or replace the time deposit for another 1 year. That's basically interest rate risk. That's another role of ALM, is to manage that interest rate risk, to decide what to do with that financial risk ahead of time. Now, the ALM, if they have access to derivatives, they can enter into complex transactions to lock in the 1 year interest rate 1 year from now, thereby fixing the cost portion ahead of time. So that's another option for ALM. Another option is to look for a 1 year, look for another transaction of 1 year loan that will mature, matching the time deposit 1 year from now. That's another thing. Or make a placement with a counterparty bank or interbank for 1 year and refinance it by then or match it by then if the outlook of interest rates are going up. So again, ALM is a bit, we're trying to simplify here, but imagine your ALM handling hundreds of thousands of loan products and hundreds of thousands of deposits. So they have to aggregate those and perform those analysis on a dynamic basis. Okay. How do we define interest rate risk? Interest rate risk is the risk that current or prospective interest rate risk, the current or prospective risk to the bank's capital and earnings arising from adverse movements in interest rates that affects the banking book position. The banking book is simply the loan book of the financial institution. So your loan book is being financed by the deposit portfolio. And interest rate risk is the risk that changes to prevailing market interest rates will have an adverse impact to the profitability potential of the business. So again, there are multiple combinations of interest rate risk. Could be differences in the volume of loans and deposits being disbursed, to the commercial rates and terms being agreed upon by respective lending and savings units. But the primary driver usually would be the tenor. Kasi siya yung pinaka variable in terms of the decisions being made in lending and deposit taking. The interest rates are guided by market, but again, there are other decision and factors that are at play when fixing the commercial terms and conditions of loans and deposits. Now, there are different types of interest rate risks, and let us go through through them one by one. The most common would be repricing risk. Repricing risk is the risk that arises from timing differences between the rate of change or cash flows from assets, liabilities, and other off-balance sheet items. In this case, ideally, yung funding cost mo and your asset yield ideally have the same tenor. That would have been simpler for ALM. Now, in this particular case, if the cost of funding is 6.5% and the assets yield is 7.5%, then the spread or the margin earned by the co-op would be 1% or 100 basis points. 100 basis points is 1%. Why do we use basis points as a terminology? Because if we say prices increase by 1%, you would compute a price times 101%. But if we refer to basis points, prices increase by 100 basis points. That means prevailing interest rate plus 1% or 100 basis points. This particular case, the asset yield is 100 basis points higher than the funding cost. Therefore, the margin in this illustration is 1%, 100 basis points. Now, this would have been nice if the tenors are the same. But in reality, funding cost, especially for banks and financial cooperatives, their funding sources are mostly short-term in nature. Whereas asset yields are at times on the farther end of the maturity ladder, meaning they will mature beyond 1 year. In our illustration, funding cost is 6.5% for 1 year, but the asset yield is at 7.5% for 5 years. So the repricing risk is the difference between the tenor of the two. Why? Because after a year, your funding will mature. Kasi 1 year lang dito eh. While your asset still has 4 years remaining. Therefore, the co-op must refinance that asset, either by borrowing again for 1 year or could be longer. But the issue there is that funding cost of 6.5% this year or today, when they refinance it 1 year from now, could have already increased. Whereas the asset yield has been fixed at 7.5% and still has 4 years remaining until you reprice it. That's the repricing risk. The risk that any changes to the interest rates subsequent to the repricing would eat up on the margin or spread of the financial cooperative. Another source of interest rate risk is basis risk. Basis risk, basis, the basis that you peg the interest rates. The risk here is that if interest rates across different tenors and across different bases change in varying degrees, for example, your funding cost increased by 50 basis points or 0.5%, but the asset yield, the basis, only increased by 25 basis points. The new spread is shorter or tighter at 75 basis points. And that 25 basis points loss is your basis risk. So kanina, repricing risk is the risk that if I need to refinance my asset because they have different maturity dates, the risk is that interest rates would have changed in such a way that it would eat up on my margin. Basis risk is that they have different bases, and because they have different bases and they move, the bases move in different magnitude, it would again eat up on your spread. Another interest rate risk could be yield curve risk, the risk that interest rates of different maturities may change by a different magnitude, meaning your short-term rates from overnight to 1 year, your long-term rates of more than a year, they change in different magnitude and direction. It could steepen, meaning interest rates would go up, especially at the far end of the curve, at the longer end of the curve, meaning it is anticipated that there would be higher issues or risks in the future compared to today. Interest rates could likewise steepen or flatten, meaning interest rates would go down, especially at the short end. Or interest rates could invert, meaning short-term interest rates are higher versus long-term rates. The risk is priced in at the short-term end, mas maraming issue in the short term, and they expect in the long term, things would normalize. So the issue here is that yield curve risk tells you that once you price your loans and deposits today, changes in the environment, in the market and economic environment could shift your interest rate basis in varying directions and degrees. And that could cause margin compression on the part of the lending institution. This one is option risk. Option risk is that you know that you lent out money for 5 years. However, there is a condition of a prepayment, meaning if the borrower wants to prepay, they can do so. That option to prepay introduces an additional risk to the equation. In this case, for example, if interest rates went up in terms of the 1-year deposit by, let's say, 50 basis points, and the bond all of a sudden prepaid. So before, you know that you have a 5-year asset that will earn you 7.5% per annum for the next 5 years. Because they prepaid and the asset yield basis went down, it's possible that your new earning asset has a lower asset yield. So from 5 years at 7.5%, it became 4 years at 7.25%. That change, no, compressed the spread from 100 basis points to just 50 basis points or 0.5%, 0.5%. This is actually a combination of basis risk and repricing risk. Because not only did you lose margin due to the changes in the cash flow behavior, you also lost a portion of it because of the changes in tenor. So those are the interest rate risk types that ALM tries to manage within its mandate. Okay, looking at the balance sheet of credit and banking cooperatives. Again, you have loans and investments on the asset side, deposits as main source of funding at your liability and equity side, net interest income as main source of revenue. Okay. There is a question here. Is this applicable for both flat rate and diminishing? We are using diminishing in lending. Diminishing meaning amortizing. So suppose there is a 3-year loan and parang 36 months. So every month, the borrower will pay back the cooperative. A portion is principal, a portion is interest. In such a way that the principal balance is going down. Correct? So diminishing balance. Okay. That's relevant in the sense that, yes, that's true. One, the cooperative, by applying diminishing balance, principal balance for lending, minimizes credit risk kasi you're getting a portion of the principal back. Your earnings potential also gradually goes down, but you've already priced that when you set the interest rates of the loan. Now, for purposes of interest rate risk, it also poses a challenge because a portion of the principal is coming back. Now, if you're the decision maker and you're given constantly amounts of money to invest, yesterday, kakaisip mo pa lang, where am I going to invest this amount of money? Today, you're given another amount of money to invest again. And you have to balance between making sure the yields are the best one I could get, the borrower is credit worthy, that they will pay it back. So the answer to your question is yes, it's applicable both to a bullet payment or flat amount payment at the end of the principal period and on a diminishing balance basis. I think I'll have an illustration there just to visualize in terms of the diminishing balance approach on how to perceive the risk when it comes to cash flows and interest rates for those types of loans. But the bottom line here is that ALM looks at the loan and deposit portfolio of a co-op on a co-op-wide perspective. So it doesn't matter as much on whether it's flat or diminishing. Rather, it's more relevant on a schedule-wise. If, for example, bulk of the schedule of cash flows, kahit diminishing yan, they fall at the 6 months, then the co-op's risk is concentrated at the 6 months. Parang ganun. So, yun. The answer to your question is yes, it's applicable. I hope I did not confuse you any further. Oh, sorry. Okay. So, looking at the balance sheet, comprised of financial assets and financial liabilities, we can further decompose the balance sheet into 2 groups. One group is your floating or repricing, meaning the cash principal amount is tied up at a longer period of time, but their commercial terms get repriced frequently. Example, I'm going to buy a condominium and there's a 15-year condominium loan from a bank. However, the bank will not give me a 15-year interest rate. That would be absurd. Instead, they'll offer me, okay, what do you want? 1-year repricing, 2-year repricing, 3-year repricing, or 5-year repricing. Meaning, depending on the frequency that I choose, my interest rate would would change or get updated every 1 year, every 2 years, 3 years, or every 5 years. That is what repricing means. That is what floating means. The loan is for 15 years, but the interest rate changes every 5 years. Example. So it floats every 5 years, or it reprices every 5 years. Now, the condominium loan is amortizing or diminishing, meaning whenever I pay my monthly amortization, it gets, the principal amount goes down, but the interest rate basis gets repriced every 5 years, depending on the repricing tenor I select. And floating rate assets and liabilities are sensitive to interest rate risk, and that risk is reflected in the interest income or the net interest income. Why? Because future changes in interest rates that is being pegged to loans and deposits impacts future profitability. So your cash flows would change over time. Because if it's a 15-year mortgage but reprices every 5 years, there is a risk that by the time it reprices, interest rates would have already gone down and your your revenue potential would have already been diminished. That's a risk. Another part of the balance sheet would be your fixed rate. Ito naman yung maturity date. Your commercial rates and interest rates do not change all the way up to maturity. If you borrowed for 5 years, the interest rate peg is fixed for the next 5 years. Unlike yung floating, where in 15 years before I pay back the entirety of the principal or fully pay back the entirety of the principal. Pag floating, you can change the interest rate every so often. Pag fixed naman, there's no changing of it. It's pegged at that rate up all the way up until it matures. Fixed rate assets and liabilities are susceptible to interest rate risk, and their riskiness is reflected in the company's capital and any trading gains or losses. Because this exposure comes from potential changes to the fair value of the balances of those assets and liabilities. Let me elaborate further. Okay. Fixed rate, meaning when you plot the cash flows of the asset, it will remain the same for the foreseeable future until its maturity date. Floating rate, now before maturity date, the commercial terms will change. So interest rates could get repriced annually. Now, the loan is for 5 years, but the interest rate changes every year. Now, fixed rate assets and liabilities are exposed to fair value interest rate risk. While floating rate assets and liabilities are exposed to cash flow interest rate risk. What is the difference? In a fixed rate situation, your cash flows do not change over time. But the fair value of those cash flows fluctuate depending on the direction of interest rates. Cash flows is flat, fair value changes over time. If it's a floating instrument, the first period is fixed, but the rest are floating or repriceable. And in such a situation, you're not exposed to fair value risk before the next repricing. but you are exposed to changing cash flows. What does that mean? It means that if I fix my cash flows for the next 5 years and interest rates move, making my decision a bad one, I cannot do anything about it. And that wrong decision is reflected in the fair value of the asset that I have decided on. Now, if I decided to make it floating rather than fixed, sure, any interest rate changes that is in my favor will be reflected in subsequent repricing periods. But if interest rates go the other way, I will now be exposed to fluctuating cash flow sources. Kasi nga, every year, my cash flow basis will change. So in short, whether fixed or float, there would always be interest rate risk. It's up to ALM to devise a strategy to minimize the adverse effect of having both assets in your books. Now, one of the common tools used by ALM to understand the cooperative's interest rate risk profile is by plotting or developing a gap schedule. When I say gap schedule, you have to plot into a table what are the sources, the potential funding or asset gaps of the company. You begin by having an opinion on where the interest rates would go. Is it going to go up or going down in the next couple of weeks, months, or years? Next, we decide what are the relevant tenor buckets, meaning, am I going to focus on overnight and then less than a year, then more than a year, or do I make it a lot more granular? Once you have decided on that, you determine which of your assets and liabilities are rate sensitive, meaning which of these loans and deposits are floating or repriceable before their maturity date. Those are your interest rate sensitive financial assets and financial liabilities. Then once you've plotted that, you determine the net cash flow position or interest rate position of the cooperative. So usually, a bank would have net liability from those instruments maturing on demand or overnight all the way up to 1 year. And then net asset naman sila at the long-term end. There's a question here. Based on your experience for the past couple of years or 5 years, which one would be more beneficial? Floating or fixed? Right. Hindsight is 2020. Is that saying? Hindsight is 2020. Whatever that means. Sorry, I'm not that philosophical. What it means is that it's at the time you're making a decision, you don't have all the information, no? So you make probability guesses. What's the highly likely situation in the future today? No, I'll make a decision that will have an impact in the future. And when you ask which one's more beneficial, floating or fixed, the answer to that question is it would depend. It would depend on the financial institution's situation. If the lending entity or institution is comfortable managing fluctuating cash flows in the long term, then floating rate is the better option. However, if the entity is focused on keeping stability of cash flows, then fixed yung products that they would pursue. And I know of some institutions, no, most of the lending entities, the lending companies and financing companies, most of their consumer loans are fixed in the sense that someone borrows for 1 year, interest rate will not change over that period. But predominantly, especially for consumer loans or individual loans, most of the time it is floating. It gets repriced. Home loans, because of the long-term nature. Car and vehicle loans, usually up to 5 years yan. They are pegged at fixed. So, but because the perspective there is that the amounts are not as large compared to a home loan, and the volume of loans will even things out in terms of the issue. So overall, in my experience, it would depend on the entity, it depend on their risk appetite and comfort, and it would depend on the products that they offer. So I hope I answered your question. Okay. So when you plot a gap schedule or a gap table, the goal here is that you aggregate the loans and deposits of varying disbursement and receipt dates, varying maturity dates, varying profiles of fixed and floating. And from there, you get a summary figure showing you your net liability and net asset position. And ALM can then make a decision on what to do with those risks. Now, looking at this image, the risk being the primary concern of ALM, if it's on a net negative or net liability position, is refinancing risk. The risk that if I go out and borrow funds to plug that gap, interest rates would have already gone up. That's my risk. The risk for a net asset position is reinvestment risk. The risk is that by the time I receive the money, interest rates have gone down. And so, when I try to look for a replacement asset, the earning potential is now lower. So, between the two, of course, you would want the money to be received, no? Always at net asset, but it doesn't happen all the time, especially for a uh, a financial cooperative that handles both asset lending and savings and deposit taking. If it's a credit cooperative, it's possible you'll always be at a net asset position. In fact, I would assume that since for a credit cooperative, most of the loans are funded by member contributions, which are equity by nature, you would always be net asset. The problem there is that you're exposed only predominantly on one side. If interest rates go down, then any new loans will be priced at a lower rate, which limits your revenue potential. Of course, if interest rates go up, then you can relend at a higher market rate. But for cooperative banks, they are exposed to both sides. So if interest rates go up, they're exposed to refinancing risk. If interest rates go down, they're exposed to reinvestment risk. It will only be evident if ALM aggregates all the loan and deposit positions and calculates on a net basis all its maturing cash in and outflows. Now, putting numbers into that illustration, we can simplify it this way. Suppose that the bank has 2,000 worth of total assets, the equivalent amount of liability and equity. And that if you break down the composition, 1,000 floating rate earning asset, 850 is fixed, while the balance is non-earning. For liabilities, we could say that 1,400 is floating and 400 would be fixed. In this particular illustration, no, we're not gonna consider the age or the maturity bucketing for no. We can see here that we are in a net negative position or negative gap. How was the negative gap calculated? 1,000 floating rate assets less 1,400 floating rate liabilities. The difference is 400, which means we have higher rate-sensitive liabilities than rate-sensitive assets. It's not necessarily bad, but it tells us what is the position of the financial cooperative. Now, the calculated interest income is 59, and the interest rate margin as a percentage of total earning asset is around 3.19%. Now, risk is forward-looking, and ALM, the role of ALM is to anticipate changes in the market. Suppose that the ALM unit anticipates increasing interest rates by approximately 100 basis points or 1%. Because the bank has a 400 net gap, the effect of an increase in interest rates is higher cost of funds. Because of higher cost of funds, that would eat up a portion of the net interest income and interest margin of the bank. From 59, naging 55. So, 4. From 3.19%, naging 2.97% na lang ang net interest margin. The effect of this transaction, sure, it increased the yield of floating rate assets from 7%, from 8%, from 7% to 8%. It likewise increased the cost of funds from 3% to 4%. And the effect of that transaction is a negative 4. Yung floating rate assets and liabilities mo, yung fixed rate earning assets and incurring liabilities mo, they don't change because they're fixed. This transaction results in a lost income of around 4 pesos or 22 basis points decrease in profitability. Now, let's look at it the other way. What if interest rates fall or decrease by the same rate, 100 basis points? Since you are at a net negative position, that would translate in a positive to the bank. So, yung earning assets mo from 6%, from 7%, naging 6%. Yung floating rate liabilities mo from 3%, naging 2%. And since you have more liabilities than you have assets that are floating rate, that resulted to a savings of roughly 4. So your net interest income of 59 becomes 63. And your net interest margin of 3.19% becomes 3.41%. Because of a negative gap, you have more liabilities than you have assets that are floating rate. A fall of interest rates results to savings for the bank. Okay, any questions po so far at this point? Now, the illustration shows that yung gap drives the direction of whether the bank would earn or lose depending on where interest rates would move. Remember, the independent variable here is the market interest rates. The cooperative has no way to control where the market will go. What it can control through asset liability management is the positioning on how much deposits or how much loans to put in a particular tenor bucket. Speaking of tenor bucket, it gets a lot more granular, especially from ALM's perspective. No, you need to understand at which point, from a tenor perspective, which areas of the balance sheet are you most susceptible to. So in this table, this is an interest rate gap analysis that focuses on the risk repricing profile. And the repricing profile shows you the differences in timing of both maturity and repricing. Sorry, ang pangit ng handwriting. I will change that in the future. In this particular table, your concern is to understand which tenor bucket are you most susceptible to. And you can look at it from a net mismatch on a per tenor bucket basis or on a cumulative basis. And for purposes of market risk and liquidity risk management, you can place limits in certain tenor buckets. For example, the highest amount here is the 8 days to 1 month. So what the co-op can do is manage that portion, make sure that there are enough opportunities to redeploy excess amounts there, because if interest rates go down by the time it matures, then they're susceptible to reinvestment risk. So they can decide now what to do for assets that will mature 8 days to 1 month from now. Let's focus on the 1 month to 3 months tenor bucket. In this time band, your floating rate or rate sensitive assets are 1.3 billion, while your rate sensitive liabilities are around 5.4 billion. So there's a net negative or negative gap of 4.1 billion. Now, the relevance of this portion of the table is to tell you if interest rates for that period of time changes by 1 basis point, by 100 basis point, the potential gain or loss would be that magnitude. However, when you're looking at it from a change of net interest income perspective, you have to look at it from a forward-looking point of view, which means that the change in net interest income is equal to whatever the gap is. In this case, it's negative, multiplied by the percentage change forecast mo in interest rates. So if the 2-month interest rates will change by approximately 100 basis points increase, what would be the co-op's net interest income? How would it look like if there was a change? So in this case, if there's an increase of 100 basis points at the 1 to 3 month bucket, the potential loss will be around 34 million pesos. Why are we looking at it from a 12-month perspective? Because risk management is forward-looking. We try to understand what is at risk from this point forward. Because in the past, we cannot do anything about it. Remember that, no? Past is past. So guys, you can also tell that to your loved ones. Past is past. But when it comes to managing the risks of business, risks are some things that can and will happen in the future, and you can change that by making decisions today. So it's the same with analyzing potential exposure to interest rate risk. What is my exposure? If interest rates go up, but I'm in a net negative position, how would my profitability look like? So at the end of the webinar, whatever it is that you would remember, hopefully it's that past is past. Okay. Financial no, the balance sheets, no, floating rate assets and floating rate liabilities. We've just discussed that the impact is in the profitability of the company in the future. Hey, how about if it's fixed? Now, if interest rates are fixed for predominantly majority of the products of the financial cooperative, then the impact of interest rate risk is different. Suppose that fixed rate assets is 100, while fixed rate liabilities is 70. Question, how much is the equity of this company? Based on your knowledge of accounting 101, which we've discussed earlier, you already know that asset is equals to liability plus equity. Elaborating on this illustration, how much do you think is equity? Wait lang ha. 30. Yan, thank you. The answer is 30. Now, that's why it's important to recall your basic accounting, because in asset liability management, it's likewise relevant, especially in understanding where the source of where the risk would be coming out of. In this particular case, when it comes to fixed rate assets and liabilities, the risk would come from equity. Bakit? When interest rate change, in our example here, if interest rates go down and most, if not all of your financial assets and liabilities are fixed, the effect of interest rates going down is to increase the value of the fixed rate instrument. So if interest rates go down, your new fixed rate assets is 120. Your fixed rate liabilities is now 85. How much is your new equity? 35. So if interest rates go down, the value of the co-op's equity would be 35, or it will increase by approximately 5. So that's the relevance of understanding the profile of the assets and liabilities of the financial institution. Because if there are more fixed assets and fixed liabilities, any effect of interest rates would likewise be reflected in equity. Meron din ang effect on the other way around. If interest rates go up, fixed rate assets value would go down. Fixed rate liabilities would likewise go down. And then because of the accounting equation, your equity portion would likewise change. So if you have more fixed asset liabilities than you have fixed rate assets, then this equation would change. The point here is that when you perform an analysis of the co-op in terms of asset liability and trying to understand the impact of changes of interest rates on fixed rate products, it has the opposite effect. If interest rates are going up, those fixed rate assets and investments would go down. If interest rates go down, the value of fixed rate investments would likewise go up. And that change in value is reflected in the equity portion of the balance sheet. Why do fixed rate instruments behave this way? Kanina, when we talked about floating rate investments or instruments, it can reprice anytime. So that means if market rate changes, that change in interest rates gets reflected in real time in the products and services. But if the product is fixed rate, any change in the market interest rates are not reflected, are not updated. Instead, you have to wait for the maturity of the products before you reprice it. That's why, limbawa, if you lend out money at 7.5% and interest rates went up subsequently, you missed out on lending at a higher rate. That missed opportunity is reflected as a value deterioration of that asset. Similarly, if you lend money at 7.5% and then interest rates went down, that means you locked in a higher potential return for the same asset had you lent out the following day. That's why when interest rates go down, you incur gains. But if you if interest rates go up, you incur losses for fixed rate instruments. That's important to highlight. Now, how do we analyze the cash flows of a fixed rate instrument? Simple. We plot their cash flows. Once we know their cash flows, we bring them back to present value based on prevailing yield to maturity rate, which is the market rate. In this particular illustration, the coupon rate is 5%. The yield to maturity market rate is 4%. That means that instrument is trading at a premium. The value of the bond has risen compared to the original issuance of the bond because interest rates have gone down. Now, there are a lot more statistical analysis that you can apply. First is to perform a weighted average calculation of the maturity date. Weighted cash flow weighted duration or timetable of the return of cash flows. What does that mean? You're trying to understand the true age of the bond. In this case, ang sabi niya, 5 years daw yung corporate bond. But in reality, its true age is 4.5 years. Bakit? Because a portion of the cash flow returns earlier than 5 years. That's what they call duration. So when someone says duration for purpose, what's the loan's duration? In terms of ALM, you want to know when would the cash flows come back. And in this particular illustration, those cash flows will come back approximately 4.5 years from now. Why do I need to know the duration if I already know the maturity date? The maturity period is 5 years. That 5 years is only relevant for the principal. But since there are coupon payments, the cash flows duration is shorter than the maturity date. And that duration can then be converted into a sensitivity number. Meaning, if you make further calculations, that duration becomes modified duration, which now tells you up to what percent is this instrument sensitive to interest rates. So, example for this particular illustration, for every 100 basis points increase in interest rates, the bond's price would decrease by approximately 4.38%. So that's the relevance of the this one. Sorry. Yeah. This one tells you what's the true age of the cash flows of the instrument. Meaning, approximately, I have to wait 4.5 years before a majority of the cash flows come in. Converting that into a sensitivity number, that modified duration tells you that any 100 basis point change in interest rate causes the value of the bond to fluctuate by around 4.38%. Okay. Any questions po so far with regards to gap analysis and interest rate risk? It's a bit technical, no? ALM kasi nga is a bit technical in the sense that you really have to dive deep into the cash flow behaviors of the loan products and services. The goal here is that we position the cash flows of the cooperative in such a way that it takes full advantage of whatever the market is offering. If the market says that interest rates are increasing, what you do is you lock in the funding cost now and then keep more assets that you can lend in the future. That way, when interest rates do increase, your funding cost is flat, but you are able to lend money at a higher rate, thereby maximizing revenue, minimizing cost. That's the goal here. It's just that for ALM, those that are actually charged with asset liability management, they drill down into detail. Hihimay nila up to the last maturity date. What end amount and peso on which portion will mature at what date. Hence, it's a bit technical at that point. That's interest rate risk pa lang, no? There's another element to ALM, which is liquidity risk. We have another session on liquidity risk management, April 18. But the topic there drills down further on how liquidity risk is managed overall. For ALM, the focus is to manage liquidity risk, but with the focus on making decisions on what to do to manage the level of risk taken by the cooperative. So when we talk about liquidity risk, again, looking at the balance sheet, you can view it as sources of funds and uses of funds. Your member contributions and deposits are your sources of funds. The loans and investments are uses of funds. The objective is that you have constant flow of physical cash in and out. Now, whatever you receive as deposits and member contributions gets disbursed to qualified and credit-worthy borrowers. And they pay back the loans on time, and any withdrawals are serviced timely. Now, liquidity issues arises when portion of your uses of funds do not follow through with the scheduled repayment schedule, no? Or scheduled repayment. That puts a dent in terms of your ability to pay back some of your loan obligations. Having those issues in mind also changes the direction of your funding sources. It could pose a situation wherein you have to borrow more at the long end or longer term. And it would have chain reaction. You would have more, if you have shortfall in your sources of repayments, then you have to find alternatives. And ALM is in charge of managing that situation. Let's define liquidity risk further. Okay. Liquidity risk, there are two types. Funding liquidity risk is the risk that the institution will not be able to meet efficiently both its expected and unexpected current and future cash flow and collateral needs. Basically, if you lend money and your borrower does not pay back, or the risk of them not paying back, that's credit risk. Liquidity risk is the flip side of that. You borrowed money and then you don't know whether you're going to be able to pay that back. That's liquidity risk. So credit risk is on the uses of funds. Funding liquidity risk is on sources of funds. Let's illustrate. Okay, suppose that this is your balance sheet. You have your cash, loans, investments. They came mainly from liabilities. Let's say this portion of your deposit wants to withdraw. Looking at the illustration, you can see that your cash is not enough to pay back the deposit. That in and of itself is a liquidity risk. So you're illiquid. Now, you're an ALM, what can you do? The first thing is to look for a replacement deposit. Hanap ka ng, so yan, may shortfall ka, di ba? So the first thing you do is to look for another deposit that will stay with the cooperative. That's one option. To replace your maturing loans and deposits or liabilities with new, longer term deposits. Another option is to get additional funding source. Let's say you borrow via issuing bonds or notes or bank borrowings. The proceeds helps to augment your existing cash balance, and then you can pay back the deposit. The third approach is to sell a portion of your investments, liquidate them, turn them into cash, add them to your cash balance, and pay the deposit. Now, it's easier said than actually practiced, especially for ALM. And that's another issue and concern being managed or being addressed by ALM. Okay. Again, let's look at a 15-year mortgage that reprices every 5 years. The earlier illustration that I showed focused on repricing gap. That illustration emphasized that after 5 years from this point, you're susceptible to a change to interest rates. Because when you reprice this loan, interest rates would have already gone down. That's repricing gap. Liquidity profile focuses on the actual timing of cash flows. When would the borrower pay you back? And are they going to pay you back in full? In this illustration, since the 15-year mortgage, the amortization or the diminishing balance is paid on a monthly basis over the life of the mortgage. So that's around 120, that's 10 years. So 180 months. For liquidity management purposes, your focus is on the timing of cash flows. Si repricing gap focuses on commercial terms and repricing schedule. Si liquidity management, liquidity profile, looks at actual physical cash timing. Are you gonna receive it now, 1 month from now, 5 years from now, 10 years from now? That's the difference. Why do we need to differentiate? Because they roughly use the same schedule, no? The same format. In this particular case, no, instead of interest rate gapping schedule, we call this maximum cumulative outflow schedule, or MCO. The liquidity profile basically tells you when is the timing of cash inflows and outflows. MCO measures mismatches in asset and liability maturities to determine your net inflow or outflow for a specific period and on a cumulative basis. MCO must be separated by, by types of products and combined to see the overall portfolio situation of the cooperative. The focus of MCO is to identify where are you most susceptible to liquidity requirements. So kaya nga maximum cumulative outflow. You would look at which tenor bucket do you need the most amount of money that you have to pay out. In this illustration, let me check. The entity is exposed at the 1 to 5 year mark, meaning they need to save up enough funds so that, or they have to identify sources of funds to complete this portion. No? Kasi net negative sila doon. If they were net positive, let's say at this point, they don't have to worry as much because they have enough funds to cover for liabilities and reinvest or relent. But by the 1 to 5 year mark, they'll reach a point where in they're 10 billion pesos short. So again, risk management focuses on what you can do today to manage the situation in the future. You can decide to get borrowings now, extend the liability duration beyond 5 years, or you can wait it out, monitor the risk situation, and take an action in the future. The liquidity profile focuses on timing of cash flows. Si repricing gap kasi focuses on the timing of repricing. Ito, you would want to manage kailan ba tayo magbabayad, kailan ba tayo makakatanggap ng pera. Kasi we have to physically transfer the cash from one balance to the other. Now, one important skill that ALM managers or asset liability managers would have is the ability to carve out and identify the portion of deposits that actually stay with the company or with the bank. Now, contractually, if 80% of the deposits of the cooperative are on demand, current account or demand account, meaning at any point, the depositor can withdraw their money. Contractually, that's possible. Legally, that's possible. However, when you look at it in practice, not all depositors would withdraw their money at the same time. In fact, some of them leave their money behind for longer periods of time. And that's where ALM analysis comes in to identify at which portion of the deposits comprise core deposits, which are a form of stable source of funding, and which portion are volatile, meaning you don't expect them to stay with the cooperative for very long. And in fact, you anticipate that they will be withdrawn in the next couple of weeks or months. The additional complication here is what to do with the difference. part of ALM is making an informed judgment as to the actual tenor or duration of your funding source. If we have 100,000 depositors, how confident are we that 70 to 80% of them will not withdraw in the next 1 year? That only 30% will probably withdraw 50% or 100% of their deposit balance in the coming months. That's basically the guesswork that's being done here. So statistically, no, that's how it would look like. In this particular case, they look at 180 days worth of deposit balance, daily balance, identified what's the average, and from there, infer that this portion of the deposits will stay for at least 6 months. This portion will stay for the next 3 months. And this portion will withdraw the next day. Again, why is it important? It's important because it guides ALM in making decisions in terms of funds deployment. Remember, the savings unit will look for depositors, and they cannot influence whether those depositors are demand depositors, savings account, or time deposits. And lending units also, as much as possible, will try to sell their loan products, whatever that they have. If it's a 3-year personal loan or a 1-year MSME loan, they will stick to that. Now, you would, as ALM, as asset liability managers, we need to establish the core funding basis, that the funding amounts that we need, because that amount will change over time. But the skill required is for us to identify at which portion you would know will not change. So may konting ano rito, forecasting, and that's where great institutions distinguish or differentiate themselves from the good ones. Those who are able to provide the best possible deposit products, which encourages these customers, depositors, to keep and leave their bank balances untouched for how many years. The way I can highlight that in terms of practice is by contradiction. So I'm sure you're aware of the digital banks offering interest rates at a very high rate. So one digital bank offers 6%, one offers 7.5%. I know of a bank that offers 15%. No? Time deposit, savings deposit. So that rate is absurd, because if you go to the Metro banks and the BPIs and the BDOs and try to pay the time deposit, the highest that you would get is 2% before taxes. So the lesson there is that these digital banks, their goal is to simply get as much deposit as possible. And for them to attract it, to attract new deposits, is to dangle high interest rates. However, the cautionary side here is that once those interest rates fall back down to earth and becomes normalized, what do you think will the depositors do? Will they stick with the bank if the sole reason why they switched to that particular bank is because of the high interest rates? If interest rates went down more than what the depositor can accept, tendency is for them to leave and pull out their funds, return it back to where they came from. So this analysis in the perspective of ALM have to factor in the product's features as well as the behavior of the depositors and borrowers. Now, if you've heard of repurchase agreements, Repos is a way to fill in the gap. Now, if a co-op bank has excess government securities, they can use that as collateral. They don't want to lose ownership of that asset, but they also need short-term funding. So what banks do is they sell those assets to a counterparty. They sell it today, but there is a promise to buy it back the following day or the following week. That buyback is technically collateralized borrowing and lending. So those transactions help ALM bridge the gap, especially if it's short-term in nature, meaning overnight up to 1 month. Another important aspect on how ALM works is adapting to the changes in regulation. And right now, the BSP is pushing hard in terms of full adoption of the National Retail Payment System. That means that more and more financial institutions, including cooperatives, would be required to adapt to real-time fund transfers using technology. So this is where you leverage InstaPay, which is real-time fund transfer up to 50,000 pesos. PesoNet, which is a batch processing. It's like check payment, but electronically. And that that feature puts puts pressure on the cooperative banks' intraday liquidity requirements. Meaning, what do we mean by intraday? Within the day, you know your opening balance, but because of transactions by your savings and lending units, your cash balance would change over time, flipping between net positive and net negative by the hour. Intraday liquidity means keeping the cooperative bank liquid while also taking on those transactions on an hour-by-hour basis. And ALM, again, is involved in managing that position. Okay. One important regulatory ratio being monitored is the minimum liquidity ratio for standalone cooperative banks. The liquidity ratio is calculated based on the activities of the co-op bank in terms of their deposit-taking capabilities. It's calculated as a portion of total liabilities as well as any other obligations to pay out in the future, comparing it against the available liquid assets of the bank, such as cash on hand, reserves deposited in the Bangko Sentral ng Pilipinas, overnight deposit facilities and term deposit facilities, as well as reverse repurchase agreements, debt securities issued by the Philippine government, and deposits with other banks. The minimum liquidity ratio states that the proportion of these liquid assets must not go down by 20%. Or stated differently, co-op banks must maintain liquid assets, as defined here, at or above 20% of their total liabilities and irrevocable financial obligations. And ALM is in charge in making sure that the business maintains liquidity at this level. Another thing that ALM does in terms of liquidity management is performing stress testing. Now, business as usual, normal course of business, you would encounter risks which are, at most close to average amount of risk and losses. So when you try to measure the risk sensitivity, you'll end up close to that level. Stress testing, the goal here is to put the financial institution in a stressful situation in terms of market liquidity and interest rates. Identifying those events that are highly unlikely to happen anytime soon, but if they happen, they would have a significant financial impact to the institution. And the third type would be reverse stress testing. Reverse stress testing naman is you try to understand what's the breaking point of the financial position of the co-op. And once you've identified that figure, you work your way backward. What would be the event that would put the co-op on the brink of collapse? Knock on wood. I'm not saying it will happen, but again, the point of ALM and risk management is to anticipate what can happen in the future, including anticipating and taking proactive actions in event of a crisis. So if you're trying to manage the liquidity position of your financial cooperative, part of your goal is to anticipate what could happen in the future, and if it's stressful to the financial position of that cooperative, what would you do if that event happens? Would you sell a lot of your assets or ask for more member contributions or get on additional debt? Speaking of crisis, a liquidity contingency plan is likewise important, especially for financial institutions that take on deposits. So, a liquidity contingency plan, as the name suggests, you invoke that contingency plan in the event certain rare but catastrophic situations occur. The plan should include early warning trigger signs, on when you should use and invoke the contingency plan. It should identify who are the officers that must play a role in implementing proactive and reactive action items within the plan, as well as the actual actions to be taken. Okay, so in summary, in terms of the second section, how ALM works. The focus of ALM is to consolidate, centralize, and manage at scale the interest rate risk and liquidity risk of the financial institution. When you look at it from a GAAP perspective, ALM manages the position of the co-op on whether it's a net asset or net liability, depending on the tenor bucket, and takes proactive action or decisions today in anticipation of what may happen in the future. And the role or the mandate of ALM includes making sure that the financial cooperative is in compliance with regulatory limits and prudential regulations affecting assets and liabilities. Okay, time now is 2:35. Let's take a 10-minute break. Let's be back by 2:45 p.m. Ms. Paris?
Yes, thank you, Mr. Jobs. Again, I'll be flashing on the screen the timer for our 10-minute break so we can keep track of the time. So let's enjoy the break. Thank you. Okay, and we're back. Is everybody here? Can I see a thumbs up? Thumbs up, everyone. All right. Thank you. Mr. Jobs?
Yeah, so thank you once again. We're at the latter part or almost conclusion of this webinar. So, konting tiis na lang, no? Matatapos din po ito. Okay. So, we just completed the section on how ALM works. Again, to summarize, ALM, the goal is to alleviate and unburden the lending and savings units from the pressure of managing the risk profile of the financial cooperative. And the one of the ways ALM does this is through fund transfer pricing by telling the lending and savings unit this is the internal price, the compensation that you will get, or sorry, the performance attribution assigned to a particular business that in turn influences and drives the behavior as well as the pricing of the loans and deposits being granted to the cooperative's customers. Now, through FTP, the interest rate risk as well as liquidity risks of the cooperative is transferred into ALM, where it gets consolidated, centralized, and managed at scale. From there, interest rate risk is managed by understanding the gaps between rate-sensitive assets and rate-sensitive liabilities of the cooperative, trying to identify which time band is the cooperative susceptible to when it comes to changes to interest rates in the future. Similarly, liquidity management from ALM's perspective entails trying to understand the timing of cash inflows and outflows from a co-op perspective. Where would the funds come from and where are they headed? And when is the co-op required to pay back those deposits or receive the proceeds of loan repayments? I'm already whispering because my throat is already sore. Okay. Let me know if you're unable to hear or if it's too soft. I'll increase the volume. That's how ALM works. No, it's a bit technical, but overall, our goal is to make sure that the cooperative maximizes its profit potential by making sure to maximize potential lending opportunities given the constraints that and the limitations that the co-op would have in terms of their funding. At the same time, if they need incremental funding, the goal is to minimize the cost and risks arising from that side of the equation. Now, we move on to the third section of the webinar, which is what are the ALM areas to focus on. Now, when you look at the financial statements of financial institutions, including financial cooperatives, you can you give me a moment? Sorry. When you look at the financial statements, particularly the balance sheet of financial institutions, you can identify and understand where are the sources of their financial risks. Of course, you can look at their product catalog and see what types of products and services they provide. But the more objective basis for understanding the risk profile of the financial institution is looking at the balance sheet. Particularly, if you want to understand how efficient the organization is in terms of maximizing the sources of funds, you look at the uses of funds. And a financial institution, especially in the business of lending, they have three main purposes of why they would have financial instruments in their books. The most common would be hello. Yeah. Can you hear me now? Okay. Again, thumbs up if you can hear me. Yeah. How about the others po? Who are awake? Okay. So there are still people who are awake and can hear me. Thank you. Ayan. Appreciate it. So when you look at the balance sheet of financial institutions, you can understand where their financial risks are coming from. So one would be looking at the consumer, for example, for their loan products, you can see where, sorry, okay. Looking at their balance sheet, you would see their products and the loans, depending on the counterparty that they service. It could be individuals, it could be businesses. It could also likewise include securities, investments in fixed income securities such as government bonds and notes. And the goal here is the goal here is to appreciate and understand why did the financial institution acquired or originated the financial asset. Now, obviously, for a credit cooperative as well as a cooperative bank, the objective is to generate funds from interest income. So you lend money to individuals, you lend money to businesses, charge them interest, collect the principal and interest, relend them again. And when you describe that objective, we can categorize that as yield accrual. The goal of yield accrual is to disburse funds, hold on to the loans, wait for them to mature, collect the principal and interest, repeat. You accrue the yield, you collect the yield. So that's the first purpose. Why you have financial, why you had have that financial instrument in your business. The second purpose why you would have financial instruments in your books, let's say you purchased government securities. So you purchased government securities. The likely purpose is to use it as a temporary parking of excess funds, but then dispose of it and sell it to turn it into cash once more. So that particular objective can be described as funding and risk management. The purpose is to place excess funds in earning channels such as treasury, government treasury bills or fixed rate treasury notes, but still have them available as cash when you need them to. So at least it's not parked in non-earning bank accounts. That's another purpose. Finally, for more sophisticated, excuse me, for more sophisticated financial institutions, they also have trading inventory. What is this trading inventory? This trading inventory is simply a pool of financial assets that they purchased with the goal of reselling them at a higher price. That's ganun din naman sa merchandise inventory. You purchase goods in bulk because you get them at better prices. Resell them wholesale or retail at suggested retail prices. In financial institutions that have trading activities, what they do is they use excess funds, purchase assets they believe will grow in value in the future, and then resell them at a higher price. So most cooperative banks would not have this type of business, but it still bears highlighting that such an objective exists. Yield accrual, funding and risk management, trading inventory. Why are we discussing these types or purposes of having a financial instrument in your operation? It drives, firstly, the sources of financial risk. You have credit risk from your exposure to loans and credit products and investments. And you're exposed to mark-to-market risk, the fluctuation of the value of your investments with changes to market variables, such as interest rates and foreign exchange. And these factors drive the accounting and financial reporting classification that you see in the financial reports of cooperative financial institutions. Now, accounting for financial instruments, admittedly, is complex. If you found ALM to be complicated already, accounting for it is a lot more complicated as well. But to simplify, this is my best effort to simplify, and I hope you would have some grasp of it. To simplify, when you account for financial instruments, you only have to ask two questions. The first question is, what is the cash flow characteristic of the instrument? Is the instrument behaving like a basic lending arrangement, wherein the objective is to collect or to collect principal and interest only? Because usually that's the case for lending business. You lend because you want the borrower to pay you back the interest and principal on time. If the contract is more than that, then the accounting would be different. Now, once you have established whether a product is a basic lending arrangement, if the answer to that question is yes, then you ask the second question. What is the purpose for having that instrument? So the first question, SPPI, are the cash flows inherent in the instrument solely payments of principal and interest? Hence the SPPI acronym. And once you've answered that question and the answer is yes, because it's a basic lending arrangement, such as a government bond or a consumer loan. The next question is, why did the cooperative acquired or held that financial asset? Is it for yield accrual? Is it for funding and risk management? Is it for trading? BMA stands for Business Model Assessment. What is the purpose? Why you have that financial instrument? The first question tackles the contract itself. How does the cash flow look like in the particular contract? The second question is specific to the entity. And when we talk about financial cooperatives, like credit cooperatives and cooperative banks, usually the reason why they have financial assets in their books is for lending purposes. So yield accrual would usually be the answer why you have those debt instruments. So in the bank's balance sheet or in any balance sheet, the financial instruments could be categorized into three groups. Fair value through profit and loss, which holds mostly investments that are volatile in nature or in terms of value. Amortized cost or AC. So most of your loans are recorded at cost. Amortized cost means that if the balance is diminishing, you update the balance on a regular basis and reflect the latest balance as of that date. Hence the amortizing portion. Fair value through other comprehensive income or FVOCI is the middle ground. This particular classification is used if you have financial instruments that are technically at fair value, but you don't want to trade them or sell them immediately because you have a different purpose for it. So as mentioned, the first question is PPI test or SPPI. What is the cash flow characteristic of the product? If the answer is its cash flows is more than just a basic lending arrangement, meaning it has other terms and conditions that you don't typically find in a loan product, then you could say that it is disqualified under the first question. Equity securities and derivative contracts, by their very nature, they don't contain any basic lending arrangement such as a maturity date or interest rate. That in and of itself disqualifies them under the first question. And because they're disqualified, the only category allowed for them is FVPL. So FVPL, if you see FVPL in the records of a financial institution, that means it is into a far more sophisticated risk environment because they are susceptible to fluctuations of the market variables. If they have FVPL in their books, that fluctuation, all institutions are exposed to that, but because they have FVPL, that fluctuation could lead to gains and losses that change daily in their financial performance. So a credit cooperative or a cooperative bank whose main objective is to provide basic banking services to its members and to the community, having an FVPL in your books does not make sense because you're not in a business of trying to game the market or try to outperform the market. That's not your objective. So you would not expect MVPL accounts in the books of cooperative banks and credit cooperative institutions. Now, at times, certain entities would have equity securities, shares of stock that were acquired for purposes of future investments, let's say subsidiaries or mergers. On a case-by-case basis, they can use the FVOCI category. Now, let's focus on products that qualify for SPPI, meaning they are basic lending arrangements. Typical loan products, personal loans, mortgage loans, housing loans. All of these represent cash flows that are repayments of principal and interest. Once you have established that that is the characteristic of the instrument, you can now answer the next question, which is, what's the purpose of the financial institution of having that financial instrument? Is it to hold only because they want to collect all the cash flows? Is it to hold, but if they need the money, they can sell it? Or is it to sell when they're able to? Now, for financial instruments that are intended to be sold and they're able to, it's for trading purposes, FVPL. If the financial instrument is to hold, but they can sell anytime if they need the money, then that is funding and risk management, FVOCI. And this is where most of the loan products of cooperative banks and credit cooperatives would qualify. If the instrument is to hold until you just collect all the cash flows, then amortized cost. So when you're from ALM perspective, it is important to understand the types of products that a cooperative offers to the market, both deposits and loans. And from a loan perspective or from the assets point of view, what type of cash flows are we talking about? Because the cash flows, as well as the objective or purpose of having those instruments, drive the accounting of those financial instruments. Now, as mentioned, asset liability management stands in the middle of both the lending and the savings units. Now, a portion of investments is likewise driven by ALM. And ALM is likewise concerned with member contributions because they would like to know what amount of cash or funds can they work with on a day-to-day basis. But we cannot forget about governance. The primary institutions or units within the bank that oversee the entire ALM strategies and approaches of the cooperative financial institution. Now, typically, ALM is managed by a management level committee, subcommittee, referred to as ALCO or Asset Liability Committee or Balance Sheet Management Committee, or in some institutions, Investment Committee. They can call it by different names, but principally, this group of managers they meet regularly, usually weekly, to talk about a variety of factors and policies that affect the ALM strategies, approaches, processes, and controls of the financial cooperative. Of course, the CEO is usually involved, or the president. Then you have the CFO or equivalent, could be the controller or chief accountant. You have the head of treasury, who could report directly to the CEO or under the CFO. Either way, this person is in charge with ALM per se, or part of its mandate is ALM. And you have representatives from the lending and savings units. And of course, you have someone who is directly charged with asset liability management. Now, in this particular group, they meet regularly, as mentioned, could be weekly. And they talk about a variety of agenda items. One would be the overall balance sheet position of the cooperative. How does our balances look like as of last week? Is it in line with what we want to achieve in the next couple of weeks, in the next couple of months, and our year-end target? It's also in ALCO, where we discuss the various sources and uses of funds of the cooperative. If, for example, we anticipate that there is, let's say, um, enrollment period, no, we anticipate that our members and customers would either withdraw their time deposits or borrow funds. Either way, you have to anticipate. And this is the forum to talk about those potential events. This is also the forum that where they discuss hedging opportunities. Are we going to take proactive and preemptive action to manage risks? Or do we take that action in the future? Since the savings and deposit generating units are in attendance, this is where they also report their achievements of targets and expectations. This is where as well they describe if they are in shortfall, what do we do? What do they do, or what do they intend to do in terms of catching up and filling the gap of the shortfall? The lending units likewise are asked to describe where are we in terms of our deployment of the funds generated, how efficient are we in terms of deriving earning assets. So for lending units, they are asked, okay, how far are you or near are you in terms of your year-end lending objectives? Are we able to manage the bad debts level to an acceptable extent? Or do we anticipate any additional businesses that can be derived in partnership with other institutions? And this is also the group that decides on the FTP, or fund transfer pricing policy of the entire institution. So in my experience, the ALCO is the venue where the lending and savings units debate on the direction of the institution, on whether they should be lending more or are they supposed to reduce deposit taking. Of course, the savings unit would always champion taking on more new business because they need to achieve the targets. But then lending units would argue that, okay, we can't book additional loans because our interest rates are not competitive, etc., etc. So ALM is in the middle, and as described earlier, they referee the competing interests between charging too high a deposit rate and lending at too low interest rate for the lending side. And the FTP policy is the guideline that sets the rules on how to implement fund transfer pricing across the financial institution. In practice, so it has to be approved by this management committee. Does it have to have board of directors or members of the board? My opinion is that it's not necessary because ALM and ALCO is a day-to-day thing. The board of directors or board of trustees, they're usually concerned with the overall and long-term direction of the institution. ALCO discusses day-to-day strategies and decisions, as well as guidelines on pricing loan and deposit products. So a board member may have significant input. And yes, you can have board members as part of the committee, but it's not critical, in my opinion. And in my experience, in like what, 4 banking institutions I've been a member with, I could say only one bank would have a board of director in the ALCO meetings. All the other banks are purely management members, although the results of their decisions are summarized and presented to the board of directors or relevant committee units. And it's also worth noting that, especially for cooperative banks, ALCO minutes of meeting are likewise part of the list of requirements to be examined by the BSP examiners. So there must be a record that a specific management unit discussed and focused on ALM policies and requirements. Okay, I'll be sharing 2 actual cases, but they are mostly happened in the US. The first one is the savings and loan crisis, wherein there are more than 1,000 savings and loan associations that have failed or folded in the 1980s and 1990s. Now, I will not, provide so much detail, but instead, I'll describe what has happened. Okay. In the 1980s, in the US, larger financial institutions such as banks were allowed to be creative with their lending products. But the savings and loans associations were restricted, meaning they're only allowed to offer select types of loans and deposits. So naturally, that hindered the profit potential of the savings and loan associations. Now, sometime in the latter half of the 80s, regulators decided to relax the lending rules and standards. So our equivalent here is the BSP and SEC and CDA reducing their regulatory oversight and letting the market decide from themselves. So this savings and loan associations, most of them, with the new freedom given to them, they decided to go all out and catch up, which resulted to excessive lending and speculation, meaning certain savings and loans association, they decided to compete with the large banks and offer complicated and complex loans, products, and services. Now, they took on excessive risks. When I say excessive risk, they lent money even to those who are not credit worthy. And they were emboldened because of moral hazard. Apart from taking cue from the regulators, regulators are now hands off. Let's go all out and lend. They also saw that having an insurance, a deposit insurance, is a form of bailout or guarantee. That if the company fails, that's fine, we'll get bailed out by the taxpayers. So excessive lending coupled with relaxed regulations and taxpayer bailout in the form of deposit insurance, further embolden the savings and loan associations to further lend at an aggressive and irresponsible manner. At times, based on the post-mortem, some of the savings and loans associations in the 80s and 90s in the US turned into outright internal fraud, wherein they falsified loan documents and collude with third parties in order to enrich themselves. One particular transaction involves certain SNL members buying real estate using their own money at market value, and then reselling that same asset to the Savings and Loan Association at a bloated price. So passing on the overpriced asset to the Savings and Loan Association and making the members of those associations bear the risk of an asset that may end up to be overpriced. So that is what happened then. It imploded, no? So 1,000 plus US Savings and Loans Association failed in that regard, and that the deposit insurance company or corporation likewise declared bankruptcy because they could not absorb or rescue that many failed institutions, and that led to updates to the regulations at least in the US. Now, I'm highlighting this because we get to learn lessons from the mistakes of others. That's one. And in this one, ALM one of ALM's roles is the internal conscience when it comes to the beat of the market. The lending units and savings units, they are always pressured to hit business targets. And because certain people will handle pressure differently, some of them may outright, push the envelope and turn into aggressive lending policies. ALM's role is to rein on that behavior. If there are pricing decisions that are outright unprofitable for the cooperative, ALM's role is to say no. No, you cannot do that. That would result in a loss to the cooperative. What ALM cannot do is to police the lending units in terms of their underwriting. That is credit risk management already, which is the topic that we will discuss next week. But for ALM's purpose, what ALM can influence and monitor would be the funds flow. And they could already flag, okay, this segment of products is problematic for the cooperative. And hopefully these lessons, we learn from them and not have similar case in the future. Another case study I'd like to highlight is the failure of a community bank in the US in early 2023. And their story, Silicon Valley Bank, begins during the pandemic. No. When the pandemic lockdowns happened, that forced monetary authorities to bring down interest rates at record low levels. The reason is to keep the economy afloat by having to support the economy through minimum consumption. No. So I'm not an economist, but basically, they bring interest rates to near zero just so that the funds held by companies will remain in the market, and remain in the economy for use of the people. Because if interest rates were very high, tendency of investors would be to park them with the market or in the market and not use it for consumption. Now, as most of you have been witness to, the pandemic lockdowns stayed for a while, for approximately 2 years. And so the low interest rate regime, especially in the US, stayed for almost 2 years or more than 2 years. Now, this introduced a dilemma, especially for investors. The market rates are at record lows, but they have excess funds. What do we do with them? We cannot place them in government securities because interest rates are very, very low. So what happened is that they turn to startups. A lot of the technology startups who are offering potential products and services that could make money in the future. There's nothing wrong in making a bet with an unproven product or service. And that's basically what a startup is. But what happened, at least in 2021, is that startup market was flooded with cheap funding. Kasi nga, the interest rates are at record lows. So basically, Silicon Valley Bank, the deposits that they receive came from these startups and tech companies who have received investor money. Because they are flushed with cash, all their cash, they park with Silicon Valley Bank. Now, the bank, their deposit base grew to $168 billion. So if you're a bank and you're given this much money, what do you do with it? You're incurring expenses. So their goal is to turn it into earning asset. The dilemma of the bank is that they don't have a lot of borrowers because their clients are also the same tech companies. The issue now is that the bank has a lot of investable funds, but they don't have a lot of borrowers. Now, what the bank did was they invested in the US Treasuries, which is, pretty prudent. The risk is low. The risk of default is low because it's the government. What can they do? They have a lot of investable funds coming from tech and tech companies. The problem here is that, remember, the interest rates are very low at that time. So for them to generate high yields, the bank invested in long-term investments. So they placed most of their funds in 10 years or above securities. The reason here is that during that time, the yields were at 3% or 4% for 10 years and 20-year investments. So Silicon Valley Bank chased those interest rates. Now, beginning first quarter of 2022, so most of the economy has started to relax. The lockdown policies began to relax. Plus, Russia invaded Ukraine or started invading Ukraine. And inflation began creeping into most of the economies, including in the Philippines. Now, the response of monetary authorities to these events in the first quarter of 2022 is to begin increasing interest rates. They gradually increase interest rates up until the first quarter of 2023, which, again, as we talked about when it comes to interest rate risk, poses a problem if your portfolio position is net negative. If you have more rate sensitive liabilities than you have rate sensitive assets. So looking at the balance sheet of Silicon Valley Bank, what happened is that when you break down their portfolio between maturing assets and maturing liabilities, their funding is mostly from tech companies. Remember, these are businesses that can easily withdraw their money because that's for operation, as opposed to consumers who are more focused on finding a bank or financial institution to park and safekeep their funds. Since Silicon Valley Bank has a lot of company clients as depositors, so most of their deposits are short-term in nature. Their mistake was deploying those funds in long-term assets. So, in Tagalog, tali. Natali ang kanilang pera. Their funds were tied up in long-term investments. Since interest rates were increasing and government securities are fixed rate, increasing interest rates means decreasing fair value of fixed rate assets. Coupled with the withdrawal of those same companies. So the tech companies said that, okay, since this bank is registering a lot of losses, let's pull out our money. So in a span of 3 days, $42 billion were withdrawn from the bank. And the cash reserve is only around $10 billion. So coupled with the bank's services of allowing for real-time withdrawals using online portals. So at the click of a button, the companies that have deposits, they don't have to line up in the branch to withdraw their funds. They just simply clicked a link or clicked a button in the portal and the funds were transferred to bigger financial institutions such as Citibank or JP Morgan. Now, this withdrawal pressure is tantamount to online bank run. So that's what happened to SVB. They were crushed by online bank run because their funds were tied up in long-term investments. They failed to anticipate an increase in interest rates in the coming years when they decided to deploy their funds in 10-year or more treasuries. So in the beginning, they were very happy that they got a lot of deposits. But in their excitement, they failed to realize that they have to generate revenue from that deposit. And because of that pressure, they looked around and shopped for the highest possible yields at a time when interest rates were at record low. And naturally, they shifted the funds to long-term investments, long-term maturing investments, because they offer the highest yields at the time. Fast forward a couple of months, interest rates began increasing because of inflation and political uncertainty. The bank, because they have a lot of fixed rate assets that are pegged at low interest rates, they began suffering financial mark-to-market losses. Those losses became evident. The depositors found out that this bank is incurring large losses. They began chatting between themselves using chat rooms and social media. And because this bank offers online fund transfer real time, these companies started withdrawing funds. So an online bank run occurred. SVB declared insolvency. and asked to be saved by the federal government. So what are the lessons from that situation? ALM becomes a lot more critical if you have products and services that result in generating assets and liabilities with maturity mismatches. Whether you're a commercial bank, cooperative bank, or a credit cooperative, you have to understand the nature of the products and services that you offer, the maturity profile of the loans and deposits that you provide. Because part of ALM is making sure that if the economic environment changes from our initial outlook, we would be flexible enough to make calibrations and adjustments to our strategies. Remember that as a business takes on more financial liabilities, financial leverage increases, increasing the financial risk of the company. When you involve more and more financial obligations as source of funding for the operations of the business, that puts a lot more pressure when it comes to interest rate risk and liquidity management. Again, the difference between liability and equity, liability has a maturity date. And that maturity date puts a deadline for the institution to generate cash flows at a specific point in time. Finally, one of the lessons, important lessons is at the end of the day, the business, financial institution's business is reliant on trust. Trust that the depositors will get back their funds. Trust that the borrowers are dealing with reputable institutions, that they are not being gouged or taking advantage of. And that the members trust the cooperative, that the cooperative will take care of the funds entrusted to them by the members. So yun. The SVB cases it's a bit scary. Again, the benefit for us is that we're seeing it from afar and we're observing from afar. But right now, we're not yet there in terms of our technological capabilities. You cannot simply click and then see your funds transfer from one bank to the other. InstaPay is limited to 50,000 pesos per day. PesoNet is batch performance. So meaning you have to wait at least 1 to 2 days before they process the transfer. So what happened to SVB is it's real time. The fund transfer was real time and it involved up to 42 billion. So, but again, no, it's the lessons that we learn from these types of situations, and particularly those lessons that are relevant to ALM that we need to focus on. So in summary, ALM has to have an understanding of the accounting and financial reporting of the financial instruments being generated by the cooperative business. If there are lending products, are those loan products, cash flows of those loan products represent basic lending arrangements? And what is the main purpose for having those loan products? Governance is a perennial main topic in any financial institution, including cooperatives, and that the policies, controls, processes, guidelines implemented, including those impacting asset liability management, must be carefully reviewed and approved of by competent internal authorities. Finally, no, ALM is all about the skillful management of mismatches. Mismatches in interest rates, in volume, and in maturity. the prudent use of leverage in magnifying the outcome of a transaction, and keeping the fiduciary duty and confidence of our cooperative members and depositors, in making sure that we keep the funds prudently managed and used. So at this point, I invite questions that you may have, or comments that you want to share, or any concerns you would like clarified throughout the webinar. Any questions po?
If you have questions, kindly unmute your microphone.